Hello class, and welcome back. Over our last few lessons, we've analyzed, recorded, and adjusted a full month of transactions for Eagle Soccer Academy. All our hard work has led to this, the adjusted trial balance. This document is our starting point. It's a verified list of all accounts and their final balances after all adjustments have been made. From this single report, we can prepare the income statement, statement of stockholders' equity, and the balance sheet. It's crucial that we prepare them in that order because they are linked. Let's see how. First, we prepare the income statement. We pull all revenue and expense accounts from the trial balance. For Eagle, total revenues are $72,000 and total expenses are $58,000, which gives us a net income of $14,000. The income statement shows the company's performance over an interval of time. Next, we prepare the statement of stockholders' equity. This statement explains the changes in the equity accounts during the period. We start with the beginning balance, add the net income we just calculated, and subtract any dividends paid. That $14,000 in net income flows directly from the income statement into this one. This gives us our ending retained earnings balance of $10,000. Finally, we prepare the balance sheet. We use the asset and liability balances directly from our adjusted trial balance, but for our equity balances, we use the ending balances from the statement of stockholders' equity we just prepared. This is a classified balance sheet which groups assets and liabilities into current and long-term categories. As you can see, our total assets of $350,000 equal our total liabilities and stockholders' equity of $350,000. The accounting equation holds. Now that we've prepared our reports, the accounting cycle for this period is nearly complete. But we have one last critical step, the closing process. Ask yourself, what should the balance of our service revenue account be on the 1st of January of the next year? It should be 0, so we can start fresh. That's what closing entries do. We must first understand the difference between permanent and temporary accounts. Permanent accounts are those on the balance sheet. Their balances carry forward from one period to the next. Temporary accounts are revenues, expenses, and dividends. They measure activity for only a single year, and their balances must be reset to 0 at the end of the year. We reset these temporary accounts by transferring their balances to retained earnings. This is done with 3 closing entries. First, we close revenues. Since service revenue has a $72,000 credit balance, we debit service revenue for $72,000 to zero it out, and we transfer that amount by crediting retained earnings. Second, we close expenses. All expense accounts have debit balances, so we credit each expense account for its balance to zero them out. We then debit retained earnings for the total amount, which is $58,000. Third, we close the dividends account. Dividends has a debit balance, so we credit dividends for $4,000 to close it, and we debit retained earnings. After posting these entries, what is the balance of each revenue, expense, and dividend account? The answer is 0. And what is the ending balance of retained earnings? It's $10,000, exactly what we calculated on the statement of stockholders' equity. And with the closing entries posted, the accounting cycle for Eagle Soccer Academy's first month of operations is complete. We have successfully taken a month's worth of business activities, adjusted them for accrual basis principles, reported them in the financial statements, and prepared the books for the next period. The ending balance of retained earnings on the 31st of December will become the beginning balance on the 1st of January of the next year, and the cycle will continue.